The conference is now being recorded.
Ex business loans, the year-on-year growth is 33%. Now on the NIMs and spread. I explained the one-time impact of 37 bps on the yield because of the origination costs on unsecured loans, which we have taken a charge for. Adjusted for this, our normative yields would have been 16.6%, and the spreads would also have been higher by this amount. We have continued our focus on core income growth and done a lesser direct assignment on the mortgage book. This has resulted in net gains from direct assignment coming at a negative number, which reflects the deceleration in direct assignment. While both of these numbers have resulted in a spread compression in the quarter, we expect the spreads to be more normative from next quarter onwards. Now on the OPEX side. The OPEX grew 9% year on year. The operating costs for the quarter reflect a lower origination cost due to overall lesser originations in Q1. However, they also factor certain cost rationalization measures taken in this quarter, which were done to create room for an OPEX expansion from the new branch investments, which we plan to do in this fiscal. Okay. One example of the rationalization measures is the co-location of 23 branches and consolidation of 3 branches, which Parvez articulated. As we continue on the branch expansion journey to capitalize on the opportunity before us, we expect the OPEX to go up to more normative levels, but driven by more capacity-driven spend. On the treasury side, in terms of total, on a quarter-on-quarter basis, our weighted average interest cost on overall borrowings has gone down by 16 bps from 8.72% to 8.56%. This decline has been facilitated by resets on the external benchmark linked borrowings, as well as a diversification of the resource mix by substituting local currency long-term debt by external commercial borrowings. We did our maiden external commercial borrowing this quarter. It is the first of a few, and it now constitutes 8.5% of our overall borrowing mix. Even on a fully hedged basis, this comes at approximately 70 to 80 bps lower than a local borrowing. Currently, around 83% of our total borrowings are floating rate in nature. Of these, 45% of our borrowings are linked to external linked benchmarks and another 39% to MCLR. As interest rates come down, we will see the benefit of this in our cost of funds and spreads. Lastly, our incremental borrowing cost for quarter 1 was at an average of sub 8 compared to 8.55 in the quarter 4/25. The deleverage from our BL assignment has resulted in our debt equity ratio decreasing from 4.03 in March 25 to 3.89 as of Q1 FY26. With that, I hand it over to the operator for any questions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Renish from ICICI Securities. Please go ahead.
Hello. Yeah. Hi, team. Just, one feedback. I think we've lost the first 15 minutes of opening remarks by Parvez. I don't know that is a problem with everyone, but I was there on the call since beginning, but I joined at maybe 6:45 or so I completely missed Parvez's opening remarks. But I will continue with my questions. I'm sorry if that's a repetition. So two, three things. One on the small ticket like business, right? I mean, so where do we stand in terms of restructuring of SLAB vertical and sequential fall in disbursement is just due to seasonality, or we turned cautious due to the current noise about increasing stress in this product?
Yeah. Hi, Renish. You had really sorry about the technical glitch. I will ask the operator to check but I will repeat my opening remarks at the end if needed.
No, I think we'll discuss one-on-one. Yeah. We don't want to sort of waste time for others. But yeah, sir, please.
Yeah, as far as the ST-Lab business is concerned, if we had discussed during my Q3 as well as my Q4 earnings call, we had highlighted that we are doing a leadership change. We've done that. We said that we will invest into people. We've done that. We were supposed to do the BRE change. We've done that. The grassroots level people, which I had said that it will take us Q1 plus some part of Q2 to the field level filling. That's where we are. We've almost finished 80% of the recruitment there. So as far as manpower and change and systems and processes and the incentives are concerned, we've changed all that. The business growth for us has been, we had dropped our business numbers in September to a level. From there on, we've been picking it up, and our pickup has been steady in that sense. So there is no extra additional tightening which we have done in this quarter. So it's going in the same progress. Whatever tightening was done, we had done it last quarter and previous quarter. Because some of the other players are seeing that stress. We had seen that stress earlier, but we had our own issues also to correct. So we had corrected on those parameters, both in terms of industry as well as BRE. So we have not done further tightening this month. The business growth will pick up as our people mature into their roles.
Got it. So drop in disbursement in this quarter is just because of seasonality, nothing else.
Yes, it's the Q4, Q1 effect.
Correct.
Q4 was a new team, so it pushed in Q1. You will again see Q2 picking up over Q1.
Got it. And my second question is on the gold loan side. So, in past 1 year, when we look at quarterly disbursement run rate, it has actually doubled from, 2,600 crore odd in Q2 FY25 to almost now crossing 5,000 odd crores in Q1. Interestingly, when we look at the branch network, right, I mean, we have not added the significant branches in last quarter as well as last 2-3 years. So what is driving this sudden surge in gold loan disbursement? I mean, it is purely by productivity gain, or are we missing any structural changes which you might have done?
So there are two parts to this. I will give you an initial answer, then I'll ask Jagdish to add it. One is in the last 2 years, if you've seen, there has been 10 to 15% tonnage growth. We might be one of the few companies which has shown consistent tonnage growth while there has been a price growth, but tonnage growth has been 10 to 15%, in fact higher than 15% in one of the years. So there is that substantial growth which has happened. I agree with you. Last 2 years, the number of branches growth hasn't been much, but this year we plan to put upwards of 100 branches. And if you remember, we had said that first we will do the experiment of co-locating the MSE branches with the gold, and we were focused on getting that correct in this quarter. We've identified premises for gold branches, but that execution did not materialize as much as we had thought. But Q2, you will see substantial opening of gold loan branches, and we will continue to expand our network through gold branches. So those branches will be put in context of FY26 and FY27 growth. But our growth which has come from productivity and tonnage. Obviously, we've been aided by price, but price plus tonnage has been the growth.
Got it. And a marginal drop in LTV during this quarter, I mean, what is the reason? Otherwise, we have thought it will go up because of the revised RBI guidelines, but
Yeah, see, two things, Renish, there. If you remember, when you had asked me this question in December, post-December 2, we had complied with the draft guidelines of December. So we were pretty strict on us, and we had complied with those guidelines. The revised guidelines which came in were a little more relaxed than the December guidelines.
Correct.
Right now we just being so that is beneficial to us. We felt that at a portfolio level, even at a sourcing level, although the LTV benefit is there, we have not extracted the full benefit because there is a price effect which is playing. So just being we are satisfied with the growth which has come in. So we have not further done anything with the LTV.
But I mean, just a clarification. But in system, we have sort of factored the new guidelines, right? Or
yes.
No.
Okay.
Just to clarify, so we are now following the draft guidelines, which we are following 75% LTV to be maintained at the overall tenor of the loans. Okay.
Okay. So we have not yet moved to 85% LTV.
Yes. The new guidelines has to be adopted in full. You cannot go just by adopting only LTV. There are multiple things, moving items. So we are in development stage, and we expect to go live as soon as possible.
Okay. Got it. And lastly, on the profitability front, right? So since we are largely done with business restructuring, at least in terms of secured versus unsecured, so how do you see some of the ROI metrics moving in near term, let's say NIM, and more importantly, credit cost? And ultimately, where do you see ROE settling in near term, maybe exit quarter of FY26?
So, Renish, that guidance I gave you in similar in Q3 as well as Q4, and the guidance remains same because we had factored in the BL when we mentioned in Q4 too. We had said that we will focus on a secured construct, and we had factored that. And if you remember, I had mentioned that we are going through a certain stress on the ST Lab side, and that could give us certain GNPA flows, but we will still manage the credit cost within the 1% range. Now, the full financial year FY26 will take into account the fact that I am restructuring the BL piece, of which about 770 crores has gone out, but the balance still remains with me. So I will have to manage the credit cost for that. Plus, I have some of the flows which I will have to manage. So the credit cost will remain range bound 1% plus or minus 10 bips. The GNPAs, as I had said, will move up and down, but that's where the credit cost will remain. The NIMs and spreads will be range bound, but net total income, again, the way you had constructed, it will remain in that range only, Renish.
Range, you mean Q1, I mean this quarter exit or?
No, for FY26, see this quarter there will be certain items which are one-off items. That is why you will see certain items which are depressed and certain items which are slightly appreciated. What I am saying is, for FY26, I mean, if you look at our Q4 FY25 numbers, the net total income could be in that range. And against that, the credit cost could be in the 1% range, and the cost to income, which we had said would go down, but again, we are going to put branches, so it will remain stable in that range.
Got it. I do have one more question, but I don't know whether I have time or not. Maybe I will come back in the queue.
Thank you, Renish.
Thank you, sir, and best of luck.
Thank you. The next question is from the line of Digantharia from GreenEdge Wealth. Please go ahead.
Yeah, hi team. Firstly, congrats on the good performance, especially gold loan side. So my question is that earlier, let's say a year back, gold used to be around say 35%, 40%. now with the kind of construct we have, and the macros are so favorable for gold loans, our gold loan exposure may even go up to say 55-60%, if our small lap and the mortgage business does not keep pace. And I think it's very difficult for mortgage business to keep pace with gold loans this year. So any thoughts on this? Like, are we going to restrict ourselves on gold loans, or we'll let the, whatever our system allows, that growth, we'll take it in the gold loan space?
Yeah. Thank you, Digant. Again, I will refer to my Q4 call where we had given a guidance in terms of the mix, and when the BL moves out of our portfolio, the mix for gold changes. So there is that a portfolio mix which will change in the range of 43 to 45% for gold. And I had guided that it will remain between that 45 to 49%. And mortgages will cover the balance. That is our medium ticket lab business and small ticket lab business. Our small ticket lab business growth will pick up, even if that growth might not catch up with the gold loan growth. The medium ticket lab growth is still there. Furthermore, for our gold loan business, we have about 15 to 18% of CLM. Wherever this mix moves in a particular direction, we have that CLM percentage also there. So we will be in that range between 45 to 48%.
Okay. Thanks. Thanks for this clarification. My second question is that, in this, we sold down around 770 crores of business loans. Will there be any credit cost associated with that, and, either remaining book, or, the guidance which you just gave to Renish in the previous question, that includes whatever, good, bad can happen in the business loan. Is that right assumption?
Yes. So we are keeping that credit cost range bound, taking in those surprises. Say, for example, in Q1, we had expected BL to give the balance BL, which is on our books, to give a particular credit cost, but it actually gave us a little more, but we still managed it. So when I'm saying it's 1% plus or minus, we've sort of projected what can BL do, and we factored that in.
All right, great. So thank you for this opportunity, and wish you all the best. Thank you.
Thank you, Digant.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Yash Dantewadia from Dante Equity. Please go ahead.
Yeah, hi. Congratulations on a decent set of numbers. My question is, again, a continuation of the previous question of somebody who asked. Let's say your gold loan goes up higher, which it's clearly going up, the gold loan mix. What kind of exit ROA, ROEs are we going to see this financial year?
Yash,
yes.
The Q4 ROA that we had indicated, I had answered this question by giving an indication that the ROAs in FY26 will be range bound. There is an upside which we will get from the cost of funds, but we are also trying to reduce the DA income. So there is that plus and minus which is happening there, and that's where we believe that the net total income will be somewhere close to what we showed in plus or minus 10 bips, somewhere close to what we showed in Q4. Our cost to income will be in the range what it was in Q4 again. Our credit cost will be 1% plus or minus 10 bips. So that is how we are expecting our FY26 to move around. There are 2-3 investments which although there is some items on the cost side that we are working on, and we will reduce the operating cost, but there are certain investment on branches, 150 gold branches that we want to put across in FY26. That is why the cost to income will remain flat. There is a flow which is happening from the ST Lab business in the previous quarter, which we have guided, and that flow we believe will be managed, and the BL flow will be managed with the 1% credit cost. So that's the range that the ROA will be.
You were saying something about investments. You were saying something about some unrealized investments, right?
I don't think so. I mentioned about investing in branches, gold branches.
Okay. And what kind of gold finance market? Because I think Muthoot Finance and other larger players have kind of guided for a 20% growth or thereabouts. So what kind of demand are you seeing on ground? And growth 26.
So we are guided with a 25% year-on-year growth in gold with the current branches in place. And whatever new branches which are going to come in, that will give us the delta.
Great. And last question, any new segments that we plan to enter, something like a portfolio, a lot of NBFCs are giving loans based on equity portfolios and those kind of things. Are we, vehicle finance, for example, are we planning to enter new segments this year?
Yash, we are focused on rebuilding our ST Lab business, growing our gold business, growing our MT Lab business. We believe we want to be one of the companies which is focused on lab business. There are other companies which are also doing lab. We want to be focused on lab and build a proposition here. We want to ensure that a management bandwidth is focused on these three products and we bring them to a very decent, healthy profitability. So we won't be looking at other products right now till we fix what we want to achieve.
Great. I'll get in the queue. I have a couple more questions. I'll get in the queue. Thank you so much. Viren?
Thank you. The next question is from the line of Mike Mistry from JM Financial. Please go ahead.
Hi, sir. Thanks for the opportunity. I have three questions. First is mainly on the mortgage book. So our mortgage book, stage 3 has improved, on a quarter-on-quarter basis. Yeah, hello?
Yes. Mike, I'm listening to you.
Yeah. So against what the markets right now, and given the SME lenders, or most of the lenders usually, catering to these segments, they have shown some stress. So surprisingly, this has actually showed some improvement in our book. So what has driven this? And second, also on this book, how is it doing in Karnataka? And are we seeing any stress coming in from there? That's one. Secondly, you mentioned something about the additional charge which has led to your yields of 16.6%. So we actually missed the opening commentary, so maybe that was the end of that part which spoke about it. So wanted to know what was that.
Okay. So thank you, Mike, for the question. See, we were one of the few companies which had talked about the stress in our ST Lab business, but it was more driven with the challenges that we were facing in Q3 and Q4. And we are trying to revive that business. So we had certain flows in Q3, Q4. We are dealing with those flows in Q1 also. So we've had elevated flows. And those are reflecting in our stage 2, stage 3, but there will be certain actions that we have taken. We have taken a one-time hit. We've done an SR structure. So that is why you see certain way in which the GNP is looking. So there is that stress, but we are dealing with it, and we've tried to manage our credit costs within 1% plus or minus 10 bips while we're dealing with the stress. We've done structural changes on the ST Lab side in Q3. This was what we had updated, and we have progressed well there, and our disbursals have been picking up. We have tightened our BRE, and we've done certain industry level mapping where we want to focus on. So we are pretty focused on growing this business very, very cautiously. On the yield side, I think you were talking about, in my opening remarks, I mentioned that we had done assignment of business loan portfolio of about 770 crores, which was executed and derecognized from our AUM. That capital release we will deploy in secured business. And I also mentioned that we had completed a maiden issue of $100 million in ECB. So these two were mentioned. If there is anything else I missed out which you wanted to know?
No, sir, but just on the continuing with that mortgage book, so can you give us a stage 2 number particular to that segment? And maybe what was that in the previous quarter?
Yes, CVG, we have that number here right now. No, we have it particular to that segment.
No, we have it at a mortgage level.
Yeah, we are disclosing at a mortgage level.
Yeah. What will that be?
So at a mortgage level, see Q1 FY26, our gross stage 3 is 3.4. Q4 it was 3.5. And net stage 3 will be Q1 FY26 is 1.9 and Q4 FY25 was 1.9.
No, on the stage 2, sir.
So stage 2 we don't disclose. We normally don't give that information. But that being said, it has not moved much in between the 2 quarters, right? But again, I would like to highlight, see, our mortgage is a mix of medium ticket and small ticket. So it attributes stability to the, to the delinquency numbers. So that's where I leave it.
Okay, sir. And secondly, the branch mix I am seeing, I think there is some, I think the numbers on the branch mix and on the geographical mix, I think the numbers are actually different than significantly different from last quarter. So if I am correct,
So what we have done, Mike, is the branch, and I think this was missed in my opening remarks. As a strategy, we had said that we will do a collaborative initiative between our gold business and our ST Lab business. So we have successfully merged and co-located 23 branches. That is, 23 branches of our ST Lab business have moved into 23 gold branch premises. So we have co-located them and released the ST Lab premises. And we will continue this effort of co-locating these branches. So you will have these branches being double counted. That means they will serve gold customers also, and they will serve our ST Lab customers also.
Yes, sir. That I got. Actually, I was talking on the geographical mix of branches. I think that the 135 branches are in the north, right? Not in the west. I think the mix is, I think, somewhat different from last quarter. That's right.
Mike, let me check that and get back if we've done some.
Sure, sir. No problem, sir.
The mix has not changed between West and North, but if there is some error on our part, we'll correct it.
Okay, sir. Great. And all the best, sir. Thank you.
Thank you so much.
Thank you. The next question is from the line of Aditya from Security Management. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, my question was on employee cost. So our employee count has increased QOQ, but our employee costs have fallen. So what is the reason for the same?
So as I explained earlier, there is a certain part of origination costs which are given as employee incentives, right? So we have changed the structure, and I think the employee costs reflect lower originations in the quarter. So that's the primary. Yeah.
Understood. So how should we build this employee cost going forward? So 90 crores should be the run rate?
No, so thank you for that question. See, as Parvez articulated in his opening remarks, we are building up for capacity expansion, and we are recruiting people for these new branches. We will not fall short of capitalizing on the gold loan opportunity. So many of the people will start coming on board from Q2. So you will see the muscle getting built up here, and you will see the employee cost coming back to a more normative number. Also, as origination picks up, obviously Q1 is not normative for the rest of the year. So you will see the employee cost coming back. So I would urge you not to read too much into the employee cost line.
Us?
Hello.
Hello, am I audible?
Yes.
Yeah, so how big was the business loan team for us, and what are we going to do with the employees in that department?
So we had a 90-member sales team, and including the credit team, we had 90 members there. And the entire set of team, we have either moved them into other verticals, where they were given a choice whether they wanted to move into other verticals, or they have chosen where we have aided them to find another assignment outside the organization, and we've given them a long period to do that. So we've given them both the options, and right now we have about 5 employees remaining.
But just many of these employees were laterals, and I think what you also see an effect of. See, we stopped new originations in unsecured business loans in December. Right now we are 6-7 months away from that. Much of that cost has gone away.
Understood. And now, sir, you mentioned that 83% of our borrowings are floating. So how are we placed on the advances side? How much is fixed? How much is floating?
See, the entire gold loans is fixed, but it gets reset because it's shorter tenor. Similarly, on the small ticket LAP, the small ticket LAP is almost entirely fixed in nature, right? So the medium ticket LAP is the one which is floating in nature right now, and that constitutes about 31% of the mix right now. So roughly the residual, other than medium ticket LAP, everything else is fixed.
What is the frequency of repricing the medium ticket LAP loans? So is it based on repo only? Does it get repriced the next day? How is it getting repriced?
We normally do it annually, right? So we normally do it annually once we see a more stable pattern. So that's how.
Understood. Yeah.
No, but I think in terms of where you are getting, I think we will be benefited from this mix. which we have, and that was giving us comfort in terms of establishing new floors on the ROA every quarter.
Got it. And in the opening remarks also, I think you mentioned that your incremental borrowing costs are below 8% now. Is that correct?
That is correct.
Got it. Sure, sir. Thanks, sir, for answering the questions.
Thank you. The next question is from the line of Renish from ICICI Securities. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity once again. Again, I'm just, going through your, slide on this geographical mix. Now, I don't know, as you already mentioned that there was an error, but just wanted to double check that, on the best zone, we are scaling gold loan business, but at the same time, we are scaling down mortgage. I mean, is that the trend or there is an error in that slide?
Sorry, Renish, scaling down what?
Mortgage.
Mortgage business, and we are scaling the gold loan business. I will just tell you which slide I'm referring to. I'm referring to your page number 23 of PDF.
Okay.
Now, if you look at gold loan, the orange bar, the share of best branches has actually gone up from 38% in 23 to 43, roughly 5% increase for the last 2 to 3 years. Similarly, when you look at mortgage loan, the same has gone down by 5%. So essentially, it means that we are going slow in best in mortgage, but at the same time, we are going fast in gold loan in best. So we are relocating.
Yes. See, Renish, you are talking about the geographical AUM mix.
So the slide which you are...
Correct. Yeah.
Yes. Is actually AUM, yeah.
Okay. Yeah, I'm talking about geographical AUM mix. You're right.
Yeah. So the AUM could be, because, see, in the Western markets, if I have grown faster in gold loan, that's how it will reflect. And if you heard us 2-3 years ago, we had consciously said that the southern markets in gold, we will not expand as much. We will expand in the gold in the northern markets and Western markets, and that's what we've done. And that's what is reflecting on the gold piece. Similarly, in the mortgage side, you will see us penetrating our AUM in those white spaces where others have not penetrated deep. So that's how that strategy over the years has been played.
Got it. So it's a well thought strategy, right? There is.
Yes. And it is basically opportunistic in the sense of seeing that we have a proposition. If you have southern states which are already invested by certain other players who have done well there, we might as well focus on Maharashtra and Gujarat, which will give us an expansion much better. And the Gujarat markets behaves differently for gold and differently for our small ticket LAP. It might be a favored business for gold, but Maharashtra might be a favored business location for me in the ST LAP side. So that's how we would do it.
Got it. So this very, very helpful, sir.
I'll just also add that, Parvez in his opening remarks mentioned that we will chase profitable growth, not just growth. Okay. So we will keep recalibrating the markets and the growth in those markets depending on how the credit behavior is panning out and how the profitability or the yield is playing out there.
Got it. Maybe just last question, and this is more from a strategic and slightly medium to long-term perspective. But let us say, assuming 45 gold, 55 mortgage, and obviously sub 1% credit cost, are we aspire to deliver more than 15% ROE, or maybe in our mind, that's the path we are taking?
So can I answer that, Renish?
Yeah.
See, very clearly, our leverage is at an all-time low. at 3.89.
Correct.
Right? As we keep growing the book, business, the leverage will keep going up. And that's your multiplier on the ROA. On the ROA, we are establishing new floors. Q4 we ended at 2.2, Q1 is 2.3. And, we are sort of, our whole strategy has been to fortify the balance sheet and lend more certainty on our return metrics, right? And minimize cyclicality on the earnings. I think if you consider the trajectory, you will be able to extrapolate how the leverage will grow, how the margin expansions will play out, and how the ROAs will work. And I think that will lead you to a number, like the one you seem to be indicating within a certain time.
Got it. No, this is very, very helpful, sir, and best of luck.
Thank you very much.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Avnish Tiwari from Vaikarya. Please go ahead.
Hi. Yes, sir. Around 935 over DPD and around 596 crore DPD. How much of these would be from business loans, which is largely your residual book?
Avnish, I couldn't hear your question properly. Can you repeat it, please?
Sure. So, for example, you give this 30 plus DPD and 1 plus DPD on a portfolio level, and these looks like around 596 crore if I calculate on 30 plus DPD, around 935 crores on 1 plus DPD, ballpark numbers. And you have around 270 crore of business loans as AUF, around 600 plus crore as a AUM. So I just want to see how much of your book you have right now in business loans, how much of it is sitting in 30 plus DPD or 1 plus DPD ballpark. And that's a book you would try to manage in terms of credit cost, right, effectively.
Yeah, so Avnish, I don't know the crore numbers, but I can give you an indication that in the 30 plus DPD, about 0.4 to 0.5 will be BL, which is
0.4 to 0.5 of the overall loan book, is it?
That is incremental, which is coming there, is because of that BL.
So this 0.4 to 0.5 is percentage of overall AUM or percentage of just BL AUM? Like what is this 0.4 to 0.5?
You are seeing our portfolio quality indicators in our investor presentation where we've shown the 30 plus DPD.
Right. Oh, okay. So in 30 plus DPD percentage number which we are seeing, out of that 0.4, 0.5% is because of BL. Is that what you're saying?
Yeah, that is correct. And, also, if you see somewhere in the sell down slide, we are mentioning that the residual loan book on business loans is 270 crore.
Right.
And that runs down quite rapidly. So that's a decreasing number, right? So
right.
And many of them are of recent vintage. Okay.
Yeah, just to correct Avnish, I'm just doing the calculation on the fly as you are asking me.
No.
Of the 5.1%.
Right.
So around 35 to 40 pips is BL.
Got it. So 35 to 50 bips of overall portfolio is BL sitting in this 30 plus degree.
Yeah.
Great. Second question I have is, whatever you have, let's say AUM number is 618 crore and AUF is 270 crore. So the difference between the two, is there any risk on you if something goes bad in those, or that is the guy who has been assigned that loan to?
So all of what has been sold, we have a risk only to the extent of what is retained in our books, which is coming in the 270 crore number. The balance is the portion to the assignee. There is there is a full transfer of credit risk, and there is zero credit enhancement or FLDG in any of these assignments. So to answer your question, there is no credit risk on us.
Great, great. And lastly, this 270 crore which is right now on your books, typically monthly or quarterly, how much is the rate you are receiving money at? Or like how many quarters or it takes for you to run down? Of course, you will see how much eventually flows to the credit cost. But let's say roughly what is the duration which these book will run down on itself?
See, by March 26, you can visualize that this 270 will go down to about 100, 120. That 120 will go down slowly. So this 270 will go down to about 100, 120.
Okay, great. Thank you. These are the questions I have myself.
Thank you so much, Avnish.
Thank you. The next question is from the line of Patanjali from Nuvama. Please go ahead.
Hi. I had one question on MT Lab side. Have we reduced the off-book sell down in MT Lab? I'm asking this because you have disbursed about 450 crores in MT Lab, but AUM increased by about around 420 crores. So wanted to understand, have you reduced off-book in MT?
Yeah, I mean, the off-book on MT Lab will depend on what's available in the market and what's our strategy for that quarter. So in this quarter, we would have done a little bit lesser than the previous quarter.
Yeah. We also, as I explained, Patanjali, there was a capital release on the BL. I think one of our themes has been that we will use DA strictly as a capital conservation strategy. So since we anyway had the release on capital from BL, we didn't need to do too much of MT Lab assignment.
Understood. It has nothing to do with asset quality, right? Asset quality is fine in terms of prepayment behavior.
Nothing at all. See, our loan book is entirely monetizable. It is a lever we have, how much and when, and we will choose to exercise that option based on, how we want to calibrate our
thing. That's all.
Thank you. The next question is from the line of Shripal Joshi. Please go ahead.
Hi, sir. Thank you for the opportunity. So my question was on MT Lab and ST Lab. So going ahead, how are we looking at growing these two segments, especially like when do we see the ST Lab revival coming in? Because this quarter the MT Lab growth has been pretty healthy. So what has driven that? And the second part was on the ST Lab portfolio.
See, the MT Lab healthy growth will continue. So whatever this quarter you are seeing, it will continue. It has a cyclicality. So Q1 will be different from Q4, but year-on-year basis, you will see that growth. And MT Lab is a seasoned business. It has seen multiple years, and we have a very good portfolio book which is building up there. So it will continue with that growth rate. Our ST Lab business, as we mentioned, it is going through its own rebuild phase. And as I told you, on a monthly basis, we were doing lesser number of disbursals in September. Since that time, from that low, we've picked it up. We reached a peak in March, April, and then for Q1 again, it has its seasonality. It is picking up. We see our ST Lab business also doing the same growth rate like MT Lab going forward. So these two businesses will have that growth rate. We are just being cautious a little bit because the market environment has been a little cautious on the ST Lab side, but we've built in the BRE engine and we've done away with certain industries which had given us those problems. So we see a decent growth rate ahead for our ST Lab business.
Got it. So just like to what you highlighted in your later part of the comment. So when you talk about the environment at the industry level or let's say system level, how will you see what are some of the let's say industries or let's say some of the geographies or some of the customer profiles wherein you are seeing the rejection rates being elevated
Yeah, so just some color on that.
Shripal, I would not want to give you a color because see, what has happened is we are trying to rebuild our book, and our book has a issue about certain challenges that we faced in our collection infrastructure. So it has the mixture and paint of that, and that is predominant. So the market kind of a feedback. So for example, the market might face certain challenges in particular state. We might face it in some other state, and that state the state that market is talking about for us could be a mixture of our own issue plus the market issue. So that's why it's very difficult for us to give you market-related information in that distinct a manner. Once we settle down our flows by Q3, we should be able to give you that answer much more clearly.
Got it, sir. That was very helpful. I mean, that's it from my end. So, yeah, thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Operator, I understand there was some glitch. Is there anything I need to do? I need to repeat my opening comments or?
Sir, you might just want to give some color of it, and then probably we can conclude the call. I think that will be helpful.
Yeah. So since I understand there was a glitch and some of you didn't hear the I will just highlight some that we continue on our priorities of conserving and allocating capital to businesses with high ROE. We had promised that we will move to a fully secured lending portfolio, and we've done that. We mentioned that we will focus on our twin engine strategy of doubling on gold and lab businesses, the high yield ST lab business and low risk MT lab business. We will expand our gold business through branch expansion. We've done that. We have also guided that we'll be opening 150 branches. We will continue to foster synergies between our gold and lab operations. We've given you a update that we've merged 23 branches. That means co-located 23 branches. Our ST lab branches have now been, the premises has been released, and those have been now co-located with gold premises. We are persisting in our enhancing our collection infrastructure to manage delinquency. We are continuing to expand our MT lab business with minimum capital allocation. We are reducing our reliance on DA income, using DA as a capital allocation strategy rather than a profit strategy. We had promised that we will ensure the credit cost remains 1% plus or minus 10 bips, and we've adhered to that in this quarter. We've said that we have done 100% assignment of our business loan portfolio of rupees 770 crores, which was executed and derecognized from our AUM. This capital release was essential because we wanted to deploy it in our secured business. We have transferred 25 crores of non-performing assets during the quarter to an ARC via 8515 SR structure. We have completed a maiden issue of $100 million in ECB. Our gold business had a very good quarter. AUM grew 39% and tonnage grew 10%. Our MT lab business grew while maintaining stable yields. And overall, our net profit stood at about 75 crores, which is up 6.8%. So all in all, we are trying to walk the talk, and we are trying to focus on the promises that we made to you in Q3 and Q4. We are trying to rebuild, and we are focusing on building a good high ROA franchise. Thank you.
Thank you, sir. Thank you. And thank you for giving us the opportunity to host the call. Thank you to all participants for being there on the call. Thank you.
Yeah, thank you, Shripal. Thank you, everyone.
On behalf of Equirus Securities, that concludes this conference.